Get on the bull.
S&P 500 program trade by level 1. By level 1.
Wake up call, pal. Level 1. Go to work.
Okay, welcome back to Trading with GB. Today, we're looking past the immediate volatility of the Strait of Hormuz to the big trade lurking in the background. Iranian regime change. For a trader, Iran is the ultimate coiled spring. It's a nation with some of the world's largest proven reserves that has been effectively strangled by sanctions for years. So what is the current stranglehold? Right now, the market is pricing in pure chaos. We've seen Brent surge past $100 a barrel as a fifth of the world's oil, and LNG is effectively trapped behind the Strait of Hormuz. But look at the fundamentals. Iran is currently pumping about 3.5 million barrels a day, exporting roughly half of that. They've been surviving on a shadow fleet of aging tankers and selling to Chinese teapot refiners who don't mind dodging US sanctions. But this isn't sustainable. Without foreign investment and Western technology, analysts expect Iran's production to eventually collapse, similar to the slow decline we're seeing in Russia's energy sector. And what about the regime change scenario? Now, let's talk scenario X, the regime change, or a total diplomatic breakthrough. If those crippling sanctions are lifted, we aren't just looking at a trickle, we're looking at a flood. Some history. Before the 1979 revolution, Iran was doing 5 to 6 million barrels a day. And we have the Venezuela precedent. We've seen this play out recently. After the US captured President Maduro in January, the push to lift sanctions immediately positioned the Venezuelan oil sector for recovery. Iran is in an even better spot because their oil is easy, so it's conventional drilling with low production costs of $10 to $30 a barrel. Compare the margins. To put that in perspective, US shale break-even prices are closer to $60 to $70. Iran can keep pumping and making money long after the rest of the world hits their pain point. That's a good point there. We often hear about the break-even point for oil production. You could easily argue there isn't one single break even. It's very much dependent on where the oil is, what type of oil, and what is around it. In other words, infrastructure to help get it out of the ground and into the back of your car. That said, I think it's a bit of a dumbass thing to talk about. Do you really care what the break even is? What does it matter to you? If you're a fund manager or a trader or just a guy filling up his car, does it really matter? I don't think it does. Anyway, I digress. If the barrels return, the math for Brent crude changes overnight. There are estimates where we could see an initial 500,000 barrel a day jump within 6 months and another 500,000 within 18 months. That kind of volume could shave $5 to $10 off the price of Brent almost immediately. Why? Because you're removing the geopolitical risk premium. When the Middle East moves toward a long-term solution, that fear tax we're all paying at the pump and in the futures market evaporates. So what is the bottom line? As traders, we have to weigh the grim baseline where hostilities drag on and output falls to 2.6 million barrels by mid-year, against the resurgent scenario where output grows by over 10% by 2027. The world is currently starving for diesel and jet fuel, and while US shale is great for gasoline, it can't replace the heavy distillate-rich crude coming out of the Gulf. If a new regime opens the taps, the global energy map doesn't just shift, it resets. Keep your eyes on the headlines. The war premium is high, but the peace dividend for oil prices could be even larger. Until next time, this is Trading with GB.